Hi, I'm Beth O'Brien. I am the Chief Executive Officer of CoreVest. Thank you so much for attending our webinar. I'm substituting for Ryan McBride, who I know that you guys normally see on these webinars, and I assure you he is far more charming than me, but I will do my best to step into his very, very worthy shoes. He had an unavoidable conflict today, but he sends his regards. Anyway, this is a build for rent panel with an unbelievable group of experts. I'm super excited to hear what everybody has to say, mostly for a couple reasons. One, build for rent means 6 or 7 different things, and everyone who uses the term uses it in a slightly different way and has a different piece of the strategy, which is what I think is one of the things that's most exciting about it. And we're going to hear from people who are at all different parts in the cycle, who do different who touch build to rent in a different way, but every one of whom is an expert in what they're doing in this echo chain. So it actually should be a really fantastic panel. Hopefully we can get people a little bit interactive. We certainly tried in the beginning to warm up a little bit, but I encourage the panelists to ask each other's questions, me, whatever kind of moves the dialogue along. I do think, there's also kind of 3 or 4 overriding themes that I'm seeing in the market right now, and I think we're going to try to touch on each of them with some of the questions for the panelists. One of them that is all over the headlines, I'm sure each of you has been seeing it, focused on it, thinking about it, is the amount of institutional capital coming into the space. And that's because all of a sudden, people are waking up to, again, what kind of an opportunity this is. And again, when I say this, it's 6 different strategies. So it's not surprising to me that institutional capital, both debt capital and equity, especially equity right now, are coming into the space, are very focused on it. And what does it mean and which part of the strategies are they coming into? And so through some of the questions, we'll be able to explore that. I think with the panelists, the impact it's having on their strategies, maybe some people it's not having an impact, but most of us, I think, are actually seeing the impact of that influx of capital. The other piece I think we already touched on, which is that this is not one strategy. This is 5 or 6 different strategies. This is different points along. But what it has in common is new build for rent in a detached or semi-detached way. Right. And so what are some of the attributes? What are some of the advantages? What are some of the disadvantages of only renting these brand new homes? And luckily we have people on our panel too who've done both and can give us a really good perspective on that as well. And then because it's new build, obviously we're starting to see some construction issues. The cost of materials have skyrocketed, right? Supply chain issues have happened. And so what are people doing to manage some of these? And are they seeing, we're seeing that the opportunity, there are things that are positive in the opportunity, they're probably offsetting some of these negatives. But I do want to make sure that it's not all rainbows and unicorns. There's the cost of labor right now and the cost of lumber and just getting this stuff done, which has been, really a challenge in the past year, even though there's been some obvious tailwinds in the past year as well on home price appreciation and other things, lease up speeds, things like that. So I'm going to ask people to go around the horn and introduce themselves a little bit. I think I'll start with Margaret Potter, who is in Houston with Camillo Properties.
Thank you, Beth. So I'm the CEO of Camillo Properties. We are a vertically integrated, purely built to rent company from our inception till to now. We are based in Houston, and our portfolio of a little over 8,000 homes is scattered across various Texas markets. So we've been doing build to rent. Actually, we started back in 2007, 2008, before actually creating Camillo Properties as a standalone company and launching that in 2012.
Fantastic. We have Doug Napier with us as well from Cavan Homes.
Yeah, I'm Doug Napier, president of Cavan Companies, and we're a 45-year-old company based in Scottsdale, and I have, for the most part of our company's history, focused on commercial real estate, office, and with a little bit of residential. But after the Great Recession, we changed our focus, seeing a growing need and less volatility in the housing market, especially multifamily, which our bungalows, which is our horizontal apartments, fit into. So we're focused solely on building build-to-rent communities. So they're gated communities, detached with own private backyards and single story. And it's been a great model. We do about a little over 2,000 units per year. And we're kind of at the epicenter of a lot of activity in this particular product type. A lot of people coming into it. It's been very popular, and we're excited about where we are and what the future holds for us.
So what makes something a bungalow and not an SFR?
Well, bungalows is our trademark for basically a standalone detached rental, but we'll put 150 to 335 of these units in one single parcel. It's single plat, so you can't do a for sale unless you condoed it.
Right.
Yeah.
Excellent. Jay Byce in Atlanta.
Thanks, Beth. So I've been
in the Atlanta nightclub. In the Atlanta nightclub, by the way.
This is our conference room. Actually, I'm not in a Atlanta nightclub, but I've known Beth for close to a decade now, and same with Ryan.
Right out of high school. It was right out of high school.
Right. Yeah, the hair doesn't, hair gives it away. But I've been around the single family rental industry from the very beginning of its institutionalization, running acquisitions along with Ryan McBride for Colony American Homes originally, and then later running the country for American Residential Properties, and then starting ResiBuilt in 2018. We've been doing build to rent with fee builders, both at Colony and American Residential, and so I wanted to start a company of my own, focused solely on that. We built 700 homes in the last 2 years, which makes us the 8th largest private builder in Atlanta at this point. We've expanded into the Carolinas and into Central Florida with our construction operations. So we build for ourselves as well as provide fee building and fee development services to others that are getting in the industry. We're also horizontally developed and property manage everything we do internally, as well as provide the property management services for Lennar's venture.
Yeah, so the Lennar deal is pretty recent, right?
It is. Yep.
Yeah.
We announced that about 3 weeks ago.
Wow.
Yeah. Which is obviously one of the largest home builders, if not the largest in the US right now.
That's
So
right.
fantastic. Jessica, we have Jessica Barish, and she's coming to us from, I'm not sure exactly where you're located. I'm thinking the assets are in the Carolinas, but you might be in New Jersey or the Carolinas?
Well, we started in New Jersey. We still have some holdings in New Jersey. My family started about 25 years ago in residential. We went directly into residential, mostly multifamily. And then about 5 years ago, we started selling off the multi and just going single family. And then about 3 years ago, we decided to move down. The whole family moved down to the Charlotte area. And we've been moving our holdings down little by little. And we now have about 200 single family homes, very small company. It's just us, just a few of us. But we're
200 homes isn't that small, Jessica.
Smaller than many. It's smaller than many. But yeah, so we buy. We don't build at all. We buy from builders. So we do buy, brand new homes, as well as buying just directly off the MLS, some just renovated, some that need renovation. So we've been seeing a lot of competition, and, we buy from Lennar, we buy from DR Horton, and we're starting to see people, get shut out of, investors getting shut out of some of these communities. So it's been a learning curve for us as we move down here to Charlotte, but it's what we know. It's what we know, single family, and we love it, and that's where we're staying in our lane. So
can't wait to hear some of your perspectives on the differences between the two. Also, when you renovate to rent and build to rent, which are both great strategies, but certainly have some different pluses and minuses.
For sure.
All right, great. And then we also have Amanda Skinner with us from Salt Lake City, who's the VP of our construction finance program. Why don't you introduce yourself?
Thanks, Beth. Yeah, like Beth said, I'm VP of construction management here at CoreVest. We funded over $10 billion in loans, and I've been lucky to be a part of about 6 billion of those. I've been in the lending industry for about 12 years now, heavily consolidated on the construction component of lending. I worked for a small firm prior to CoreVest, where I developed a construction lending platform, something we still use today at CoreVest. I have supply chain management experience where my focus is mainly in costing and sourcing. So I look forward to a good discussion today. Thanks for having me.
Thanks, Amanda. All right, great. Let's start with Margaret on kind of the first theme. What are you seeing on this institutional capital coming in? Like, what kind of pressures, like, how is it affecting the business having all of this attention right now? And not just attention, but attention being backed up with dollars.
Yeah, no, I mean, I think that there's, to me, it feels like a bit of a gold rush mentality out there right now with all the money rushing into it. I wonder sometimes that, if we're playing musical chairs and when the music stops, how many people are going to be without chairs. But, for us, I think being in the Texas market, we haven't felt a big impact yet, but I am bracing for it. I mean, I think that the obvious issue is going to be starting with the land. I think that with this much money moving in and there's this gold rush mentality and people are looking at land, they're buying land sight unseen. So my expectation is that we're going to start feeling a lot of pressure as we, try to fill our land pipeline. I think that's going to be the biggest constraint on growth for most of us that are trying to do build to rent.
Doug, you look like you're shaking your head there.
Yeah, I think that's true. We're seeing a lot of, we're reaping some of the benefit. We're getting a lot of people contacting us because we're an established, as far as this product type goes, we're fairly well established, been doing this for about 5 years in this space. And so they want either into our space and they want to invest in our projects because we raise about $100 million worth of equity every year. But we have seen over the last 5 years, equity's gotten a lot easier, debt's gotten a lot easier, it's a lot more competitive. But if they're not in our space, they want to set up and compete. So we've seen a lot more entry to market among either new startups or even some of the longtime existing for sale home builders that are getting into this space. And as Margaret pointed out, it's driving up land prices. They are getting scarce. We can't go into an urban infill because we can't afford the price of that land for a horizontal single level product because our density is much lower. But we're fortunate in an area where we've got a lot of land expansion and the city's growing out. And quite frankly, COVID has helped that because a lot of people are moving out of the urban areas into the suburban areas where the land is a little bit more affordable. So we're able to tie up that land. And because we're only doing about 10 to 12 projects a year, you got to cast a lot of cash to kind of hook that one piece of land. But as everybody knows, you make your money when you buy the land. So you want a good site and you want one that can be entitled and you can develop because you spend a lot of time and money just getting to that process before you put a shovel in the ground. So,
yeah, Beth, just one point. I think Doug brings up an interesting thought around that. This influx of institutional capital means different things to those of us that do our model differently. At Camillo Properties, we don't take in outside equity, right? Mm-hmm. And so for me, this influx of institutional capital is fueling my competitors. Right. It's not something that is advantageous to me in any way because we don't take on outside equity where our capital stack is inside. So for me, this is fueling a lot of new competitors and not bringing any value to us.
Yep.
But it is compressing cap rates. So if you wanted to sell, now would be the great time.
Absolutely. Absolutely. Don't tell my CFO that. He's pinging me on that every other day.
What about you, Jay? Is it all competition or is some of it beneficial?
Oh, well, no, it's definitely been good for us. We were supposed to close a $150 million equity deal March 31st of last year. Obviously that fell apart because of COVID, but we were able to, find a larger and more agile equity capital by the year end and really upsizing it by almost 3 times. So, and that's really before the real gold rush, of private equity capital flooded into the space. I do think that as the markets begin to open up, some other investments are going to normalize, and some of this money will start finding other homes in other sectors. I think that when COVID hit, really build to rent and SFR in general were just one of the only really attractive places to invest. So I think that will shake out by the end of the year.
Yeah. So Jessica, since you're not starting with the land and going directly to the home builders, are you finding it similar, or like, do you find the competition similar, or is it something that you're a little more isolated from?
We're definitely seeing the competition. I can say that within just the last year, when we were purchasing houses last year, there was very little competition. We had no problem, we could buy 1, 2, 10 houses, whatever we wanted, and it was no problem at all. And now, each month as we're trying to find properties to purchase, we're going up against, honestly, mostly single, family home buyers, people that are just willing to pay, at least in our area, they're willing to pay significantly over asking price, even directly from the builders who are now putting these homes out for bid, because there's just so many buyers and there's just not enough inventory. So, they're also starting to shut us out. Some of the communities that we purchase multiple homes from aren't even allowing investors anymore. They're only focusing on home buyers. So, whether it's coming from outside equity or it's coming from other places, we're definitely seeing a significant amount of increased competition.
Yeah, I think we sometimes forget that the actual retail market is also on fire right now, right? Like we're so used to our own market that we forget that the for sale market is also incredibly robust for all of the same trends.
Yeah, for us, it's been kind of a benefit, because as the inventory for sale product has shrunk, people are renting, and people that are moving in, because we have so much in-migration, a lot of them want to rent, either hoping that prices will stabilize or come down, or they just can't figure out where they want to live yet. But it is competition. Now, we're not competing with the for sale product because we're building our own properties, but we are competing in terms of the for rent. And because the for sale product is going into for sale instead of the build for rent, it is also shrinking the rental inventory quite a bit. So, for us, it's kind of it's a mixed blessing. It's probably helping us more than it's hurting us.
Well, that's good. That's pretty positive. So I think most of the panelists mentioned some of the effect, that there are plus and minus effects of COVID over the past year. I don't know, maybe Doug, you want to just continue, and are there any highlights of that you think are impacting this market still?
Well, when we set up this business model, we were trying to appeal to a market demographic that was broad, that wanted the rental option, but they didn't want the hassle of home ownership, or didn't want to live in a traditional walk-up, either garden style or multi-story apartment. And we thought that was, it was somewhat novel. It was popular, and it was growing in popularity. But with COVID, what we've learned is now people are wanting to really get out of those multi-story buildings. They don't want shared hallways. They don't want shared HVAC systems. They don't want shared elevators, and they want space. Plus, the other thing that's kind of funny is, you've probably seen it in the headlines, is that during the pandemic, everybody bought a dog. So we have these pandemic puppies out there, and nobody wants to get up at 2 a.m. and walk down 3 flights of stairs. So now they're saying, wow, our bungalows have private backyards for my dog. And then the remote working aspect was another big thing. You walk into either a single family home or like our bungalows, you've got 4 walls with natural light, 10-foot ceilings. If you're working from home and you're on the 3rd floor of an apartment building, in the center of the building, you have 1 wall with natural light. So, our property managers have told us they're getting a lot of applicants from the multi-story urban settings out to these suburban, because they're working remotely. They don't have to drive to work every day. So we've seen a lot of uptick as a result of COVID. And so it's, again, silver lining for something that's been tragic for the country.
Yeah. Amanda, have you been seeing any differences kind of in the past year in either speed of construction funding, different types, or any other impacts of this?
Absolutely. Absolutely. I think the majority of our borrowers have all felt a crunch from this, material inflation and the cost of, labor when demand, outweighs supply right now. All of our borrowers are experiencing a pinch. luckily for them, the delays, they've built that into, their schedules. They've built in a contingency to help with some of those, cost overages. But for the most part, I think, now they're finally starting to get back on track with construction. They might not be running a full crew, on all of their projects, but it seems to be, going back to trending towards normal. But there for a little bit, yeah, they all experienced anywhere from a 3 to 6 month, just totally downtime, not really doing anything really productive and progressing their projects forward.
Sounds good. I don't know, Jessica, have you been also seeing some impacts on your portfolio from the past year, both positive and negative?
Yeah, we've definitely seen slowdowns in we do a lot of 1031 tax exchanges. So there's timelines, there's a lot of deadlines as we're moving our stuff from New Jersey. So we're finding a lot of delays, and it is starting to impact some of our decision making, as we try to fit things into the calendar, because things are they're not moving along, the way we expect them to, which is one of the reasons that we do move towards, houses that are already built, buying directly from people or renovating our own properties, because you don't have to worry about the timeline so much. So it's definitely.
Can you give our audience a feel for what are some of the differences between running a portfolio that is newly built versus running a what I call rent to rent, the renovate and rent portfolio versus the build to rent portfolio?
Sure. We're relatively new to the new build since we've been in Charlotte. So with our newest, and we've only been in that maybe a year and a half buying new builds. It's actually, it's sometimes a little more frustrating, because we're not building them, but we have to do a lot of warranty items. You have to count on the builders. You have to, when we do our own properties, our own renovations, or even houses that we don't need to renovate, when there's issues that come up, we can handle it all on our own. We do whatever we need to upgrade the properties. When we're buying from the builders, we're a little more subject to their timeline and, them responding to us and to our tenants. So it's a mixed bag. I mean, both are great. I mean, I like having the diversity, but it is difficult to count on the builders to come and handle some of the issues.
So interesting. Is there a lease up difference, or you think it's about the same? Because
it's about the same. Our stuff goes. I mean, we're listed for maybe a day, 2 days max before we're rented immediately. And every time we're re-rent, I mean, our rents are skyrocketing day by day by day. So there's just different renters. There are people that are a little more long-term that are buying in the older neighborhoods, but then there's people that don't, like, I think Jay had said that, you don't know where you want to live yet, but you're moving to the area, so they want to rent, and they're renting the new builds, because those are the people that just want to move into a new construction house.
Who doesn't want to live in the right
neighborhood,
Yeah, Beth, there is actually a massive difference in lease up if you are doing build to rent at volume. It's a huge difference. We had a staff meeting this morning, and our construction VP, mentioned that he's going to be completing over 500 houses this quarter. When your leasing department is getting off of the production line 150 to 200 houses a month, all at once, that you have to lease up, it really changes the way you approach leasing. You need to really get good at pre-leasing. We do all of our own construction, so we control our timelines. So we're able to look out and say what houses are going to be delivered on what date, and you've got to get really good at pre-leasing so that the construction is coinciding with somebody, ready to move in, shorten that, days on market. But yeah, when you're getting 200 houses a month, brand new, that need to be leased, it really changes the way you approach it.
Although it looks like it's going pretty well. I saw you actually closed down one of your leasing offices the other day. I'm not sure why I saw that. Like, it came up in one of my feeds.
Yeah, no, pre-leasing has been a huge focus, and it really requires, obviously, we're completely integrated. If I was working with an external builder, having that tight integration that Jessica mentioned, and communication about when exactly the houses are going to be ready, which is one of the nice things about build to rent, is that when you're building the same, plans, continuously, you really get that fine tuned and you really start to know, look, I know exactly that it's going to take this many days to build this plan, maybe build in a tiny buffer and then figure out how to get your pre-leasing to coincide with that.
Yeah, lease up really is a lot more similar to apartments than the scattered single family site. So like Margaret said, we focus on the pre-leasing so that we're not, met with a big backlog. That of course gets even more complicated when you're in a bigger project and your pre-leasing starts to compete with renewals. But it's not uncommon in the apartment business. The great part about the way Margaret and ResiBuilt do this is that you don't have to build all 300 units at one time. So we're able to, throttle back if we were need to, or accelerate as we have been lately to, delivering 12 to 15 units a month in most communities.
Yeah, Jay's exactly right. We look at it as points of sale and absorption rates. So we take every project that we've got going simultaneously, look at what we believe based on demand, the absorption rates will be, and then you fine tune your construction and delivery cycles for each community. So yes, we might be getting 200 houses delivered this month, but that might be across 15 or 16 different communities that we're building at the same time.
And Doug, since your communities tend to be, tighter on one plot, do you find that the same ability to deliver like that in phases is helping, or is there some other approach?
Yeah, and of course, in that regard, we kind of compare ourselves to a traditional multi-story apartment building where you can't lease unit one until the whole building's done. And the nice thing about these detached units, we can build them in phases, depending on the size of the project. We may have 4 or 5 phases, and you get our C of Os for that phase. We'll do our pre-leasing as it's been suggested. So by the time we finish a phase, most of the time we're 100% leased and they're moving in, and then we're finishing out the next phase. So it's also nice because you got cash flow coming in on a project in phases. So by the time you're done, you've got money coming in, you're leased up, and you're ready to move on to the next project. And you track just the rental rates from the time you start to the time you end, and they just keep going up. And I don't think we've gotten to a place where we've gone full term where we've gotten to renewals, but by that time those renewals are already up. So yeah, it's a big advantage to be able to phase in and get them open up. But we don't we have one speed, and that's finish now. Because the demand's there, and we haven't had to pull back the throttle at all to gauge demand. There's just enough there for us. So we hope that continues.
So Jay, I know you're also managing and running both brand new build and renovate to rent. Do you see any material differences between the two in lease up right now, or strategy?
So I don't think there's really a material difference in a leasing velocity. Both sides of our house are able to lease almost immediately, just speaking to overwhelming demand. We do price them differently. Obviously, the new builds have a premium to them. And so that should create some level of separation. I will say this, with all of the new entrants into the market, many of them having absolutely no development, construction, property management, or rental experience.
And they're in the market now because I'm kidding.
Yeah, but don't let that stop you.
Look,
it's capital experience.
Yeah, you get capital, you figure out how to spend it, right? Yeah. And there are a lot of people out there. God bless them. And by the way, we'll offer our services to them. That's not a problem.
That's called thirst for yield, Jay, right? Thirst for yield, something like that.
Yeah, exactly. So, but what I'm seeing is some of them are using metrics that are getting closer and closer to absurd, right? Like no CapEx reserve and no R&M reserves and things like that, where look, on paper, you can make these things work all day long. We tend to be a little bit more conservative because we've been doing this for so long. We know that you need to have CapEx reserves even on a new house, and there is going to be a level of R&M after the 1-year warranty period. So a lot of people are going to be surprised. That's my opinion. I think land development, especially, there've been plenty of books about how to lose money in land development, right? Right now, I see sort of C and D quality sites being purchased or put under contract. If they end up buying those sites, they're still a C or a D quality site. Maybe that works, but we're still passing over those opportunities. We're still getting plenty of sort of A and B sites that work, but my concern is the capital forcing decisions to be made and mistakes happening and having some level of distress in the industry in 2 or 3 years from now.
Yeah, well, the good news about Jessica's strategy is you don't have to worry about the crappy sites, right? You're just not going to buy from those builders, right? Like if you're coming into this chain at a different point in the life cycle, right? If you're the person who's fully integrated, yes, you're making the decision up front and it's going to drive the value of the entire chain. But there are ways to participate, obviously, like Jessica does, where you're buying the house once you actually identify that that's the neighborhood or the cap rate or whatever that you're looking for.
Yeah, it's definitely the safest way to go. It's also the hardest to scale right now.
Yeah. Would you agree, Jessica?
Yeah, we're finding which are the good builders and which are the not so great builders. I mean, we do have, we have some that we've been waiting on 3, 4, 5 months past when we were supposed to close on them. And, we're certainly not going to be doing business with them again. So it's, you can identify pretty quickly who are the ones that you want to stay, close to and get your connections with and continue to try and buy from and who to stay away from.
Right.
And when you're buying, do you tend to be one of the audience is asking the question, actually, the last 2 or 3 houses in a for sale development, or are they doing a for rent development that they're selling to different people? Like, what is the character of the neighborhood generally if you're buying from the builder? Maybe it's all the strategies.
If we're buying if the ones that we're buying directly from the builder, they're some of the community is in our area right now, in the Charlotte area. It's expanding so quickly. There have to be 120 communities that we can go pick from. And some of them are at the beginning phases, some are the middle phases, some are at the end. Like I said, a year ago, it was much different. We could start, we could buy a house and know that it was going to be built in 6 months. Now, a lot of them have switched to a 60-day out. They'll build the house, they'll be 60 days out, and then they'll put it for sale. And then you have the option to bid on it, which, in the past, we never had to bid. It was the price when you're buying from a builder. But now it's no, you need to put in a bid, highest and best, by whatever time, and that's how, and then that way they can take advantage of the market, the current market, which literally is changing week by week. The prices are going up. So, we're buying at different stages within each community, whatever we can find. Right now, it's just a struggle to find houses.
So interesting.
Yeah, most of the national builders have put quotas in, both at the division level and at the community level. So they won't allow certain, any more than a certain number of homes to be sold, and that's retail or rental, right? So they're trying to curb the supply simply because the supply chains really need to repair themselves. There's a limitation on the supply and overwhelming demand right now, which is pushing these prices and the rents dramatically.
So, Amanda, when you're looking at, I know you're financing construction both for clients who are doing the renovations and some infill and some pretty heavy lift type renovations, but then also for the ground up construction on the build for rent. What do you see as kind of the characteristics of the strongest players in both of those categories? Are they the same? Are they a little bit different from each other?
I think the preparation of some of the borrowers on the ground up construction is is a little more relevant than the borrowers who are just renovating. You know, they have good liquidity, they're financially prepared, they have a strong supply chain, you know, good vendors, a good team of laborers, you know, and typically, you know, they own their own development arm, or, you know, they have a developer that's, you know, helping them along with the construction. So I think the level of preparedness on the ground up construction outweighs the level of preparedness on the renovation side, you know, dramatically.
Very interesting. So I'm going to pivot a little bit to some of the questions that are coming in. Some of them are pretty interesting. So Doug, why don't we start with you? What do you think in your communities is the balance of long-term renters and short-term, kind of the look and sees? I mean, you mentioned earlier actually that some people are just kind of testing out the Phoenix market or something like that. Like, what on balance now, how do you think it's shaking out versus kind of the longer term versus these shorter terms? And is there something that you're doing in your business model to accommodate that?
Yeah, you know, we're pretty metric driven. We do a lot of market research, and we go not only into the broader Phoenix, where we're primarily building in the Arizona market, but even in some of the sub-markets. As I mentioned earlier, our original model, kind of the profile of the tenant would be a young professional, millennial that are, you know, growing families. They want to get out of the apartment. They want to get into a home. They have student loans. They can't get a down payment. The credit market's too tight. And yet we're also seeing a huge uptick, and nationally as well as locally, of renters by choice. They want the home without the hassle. They rent everything. They rent their car if they have one. They rent their phone. They rent Netflix, and so they're kind of used to that rental market. And they just like having somebody else take care of everything. You know, they come into their gated community. They've got a pool. They've got a clubhouse. They've got a fitness center. And if there's a problem, they just pick up the phone or get on their portal, and somebody comes and fixes it. So, you know, while that was our primary demographic, and I think that'll roll into long-term rentership. You know, we have, you know, at least a minimum of 12-month leases, which is not a problem. But we're also seeing seniors and, you know, middle-aged people that are moving in, families with kids. They don't want to move into a 55+ community, but they're taking advantage of the high prices on for sale. So they're cashing in, and they're moving into our communities. So, I think the long-term market for rentership is, I don't know if it'll increase substantially, but I think there's always going to be a market for tenants. And I think that with this new product, when they say, look, I can have a whole house for not much more than I'm renting a traditional apartment, I think it's a good play for us. And so far that has proven out in spades. We have higher retention rates. We have higher rents, premiums. And during COVID, we only had one tenant who asked if they could split their monthly rent into 2 parts. We had no defaults. Fantastic. So we're getting good quality tenants. And of course, we're building them, stabilizing them, and then we're selling them to operators, because that's right now our model. It makes more sense with our depressed cap rates to sell. But if we had a long-term hold, we're in a good spot too.
Fantastic. Margaret, what are you seeing? I mean, I know you've had this you've had this portfolio for a long time, actually. Seems like your tenants are pretty sticky.
Yeah, they are much more so. We do have a limited amount of multifamily, so kind of comparing between the two within our portfolio. Yeah, the tenants are definitely a lot stickier in the single family. I think our average tenant right now is about 27, 28 months. A lot like Doug, the demographics are also quite different. We have, people are usually surprised to hear that I think it's 47% of our residents have a college degree. We have minimum credit score of 550. So these are people that, they have to show 3 times the, income of their rent. So these are good qualified residents, and they are stickier than in the multifamily. I would say that the rent per square foot, at least in our market, is a little bit higher on the multifamily side than the single family, but I think we're closing that gap. I think that on the SFR side, especially when we look at our stabilized portfolio and our ability to raise rents, that's during COVID, it's been really strong. I think everybody's seen, rent increases across the country that are really healthy. And it's all about, how what is your pricing strategy? How do you implement it? How are you getting enough? For us, we are a long-term hold. So, we look at our same store, if you will, portfolio, and look at, how are the expenses going relative to the price increases, and are we growing our NOI within the stabilized portfolio? And, during the pandemic, everybody wondered what was going to happen. And, we've actually seen really healthy price increases going on.
Sounds good. I don't know, Jay. One of the things that people are asking now too is, and I think because you have a mix of different communities, maybe you have an interesting perspective. How much are people looking for amenities? Right? Doug's communities all have the clubhouse or the pool or the things that you can have on that you associate with the single plot. Mm-hmm. What are you seeing in the mix of your different portfolios?
So I look at it a little bit differently. Whether it's amenities or the house itself, we're trying to build a community that feels exactly like for sale. I don't think that our idea here of build to rent is really that groundbreaking. It's just simply another way for people to enjoy housing. So I liken it more to like a car lease to a car. Right, in the 80s, when they really first rolled out car leases, everybody said, "Oh, who would want to lease a car? That seems crazy." And now it's 50% of the market. It's just simply a financial tool that people use to access the vehicle. So, relating that back to amenities, we'll build a 50 to 70 lot detached dedicated rental community with no amenity. And as long as we are in the right location and the right product and priced appropriately, it leases like crazy, no problem. For our larger deals, the 150 and 200 lot type of communities, we do build clubhouses with open spaces, pools, pocket parks, and things like that. But that's what I would normally do as a residential developer, because you have so many more people that, your odds of needing that common space are much higher, and it's worth the investment to do so.
Beth, if I can follow
100%, Jay, 100%. Yeah. I think that for most of our communities, the amenity is a 2-car garage and a backyard. That's the amenity that people are out there looking for, right? Yeah. And same thing, Jay. We have a sister company, Legend Homes, which is a large production builder that's focused on the first-time buyer market. And we don't build our communities any differently from them. I agree with you 100%. If we have a community with 600 houses in it, so yeah, absolutely, we have a pool, we have a clubhouse, but by and large, the amenity is a 2-car garage and backyard.
And a lot of this goes back, Beth, to what you're alluding to in the beginning. Is there really different types of build for rent? Yeah. Right.
100%.
What Doug is doing, where he's appealing to the people coming directly out of the apartments, you want to give similar features to what that apartment may have. For us, our tenants are stickier. Well over 3 years is the average stay in our portfolio. And what we're trying to do is just make life incredibly easy to own a home, take out all the negatives of home ownership, including landscaping. We handle 100% of the landscaping, and these are large lots. They're 50, 60, 70 foot wide lots. So it can be challenging at times, but once the tenants get in, just like a car lease, they're like, well, man, this is great. It's the same car, just a different way to use it.
If I can follow up on both Jay and Margaret's comments, because I think we have this internal discussion that we could probably rent up without any amenities, because to their point, people come in and they live in it like a subdivision. And so they're there because we are all in one spot, but we don't build the big Las Vegas style pools, and they're fairly scaled back. But it's funny because they'll come in and we have a small fitness center, and they'll say, "Oh man, we're so glad we have this." They'll never use it. They'll still go to the gym, or they'll just walk on the walking paths.
I thought everybody got a Peloton. Didn't everybody buy a Peloton in the pandemic?
Yeah, exactly. The only thing that really appeals to them is the dog washing station. As I said earlier, everyone has a dog. That's now an amenity, and little dog parks. They love that. We have some fire pits, but we probably could rent them without amenities. But we also want to make sure we have a have a platform that is not only popular now, be popular, in the future if the market turns soft and it's a market distinctive from some of the others. But some of these folks are going to move out of our communities into the neighborhoods that Jay and Margaret are renting out in the single family homes because they want even more of a subdivision type feel and not feel like they're in.
You want more of an amenity, more backyard, more garage.
Yeah, they want the bigger yard instead of the little pool. So.
And I bet, Jessica, you don't even consider an amenity, right? When you're doing
We don't. Yeah, no, we find that all the new communities have the amenities. It doesn't help or hurt, when we're renting, whether it's an older community that has no amenities, it doesn't really seem to make a difference.
Yeah, I think people are there for the house. I mean, look, the amenities, it is funny when I do some site visits, I got to tell you, Doug, the one amenity that people always point out is the dog washing tub, right?
Crazy.
That could be the only amenity that we actually need for any of these houses, right?
I think
Maybe
so.
in the basement.
Popular, and it gets used. I'm surprised because they have a backyard with a hose bib, but they go up to that dog washing station.
Actually, I just showed my Northeast origins. I just said we have to go to the basement, right? Most of these homes I've seen, most of you are building, would never even have a basement. But
no, not in Arizona.
Right.
That's right.
Yeah, the Northeast comes out once in a while, right?
Yeah, I miss the basements.
Basement is a good thing, but it just gets full. But then they never leave. That would be a good thing for renters because we'd have even stickier.
Right.
Once that basement is full, you are never going back to a multi.
We actually, in Georgia, we got a lot of topography. So about 20% of what we build is an unfinished basement.
Oh, wow.
And we charge a premium for it.
Yeah.
We get, $125, $150 more a month, which is roughly, the offset of the cost of building it. So it's not like a huge windfall, but Beth, you nailed it. They never leave.
Yeah. No. Somebody with a basement can never move again. Believe me, I have one. Right. I know I'm stuck. Okay, great. So there's actually a bunch of different questions around where cap rates are going and differences between multi and single family and the different markets you guys are in. Let's take a little around the horn and maybe get some market specific information on that. I don't know, maybe Margaret, do you want to start with Texas?
Yeah, I think cap rates are absolutely crazy right now. I think that, in the same way that, multifamily has traded for years and people would buy at a certain cap rate and think that they're going to improve the product and then sell at a better. People are paying money right now. They're paying cap rates as if these houses have traded multiple times and all those improvements have already been made. So I think, we're seeing cap rates as low as 3.9,
wow.
Which is crazy. And I think that, it does put some pressure on folks like me to think about maybe pruning, looking at my portfolio now and saying, well, cap rates are probably not ever going to get any better than this. And is this a great time to, maybe carve out some of the older communities that are going to have higher maintenance costs going forward, get some of those flipped and, reinvest in more new housing. At those kind of cap rates, you could, for every house you sell, you could build two. So I think that it's amazing to me. And again, it's this gold rush mentality. And I don't know when the, really the madness is going to come to an end.
You mentioned earlier that the per square foot rental on the single family is still a little bit lower than the multi, which makes total sense. Mm-hmm. But it sounds like those are compressing as well, right?
Absolutely compressing. I know with certainty
which is what's driving the cap rate, maybe. I don't know.
Yeah, we do have communities where we're now matching the multifamily and maybe even exceeding. And again, the price increases that we've been able to push even through the pandemic have been, really strong.
Well, it's interesting in the New York City apartment market, the larger apartments actually get a higher per square foot rent because of the scarcity value. And so I think what's probably driving that is some of the scarcity.
Yeah.
Right. No, I think because of the tightness of the housing market.
And I think that there's just this mentality out there right now that everybody's trying to grab things as quickly as they can. The money's there. Everybody's excited about the industry right now, and they're all trying to grab it up. And that's definitely pressing those cap rates down, the competition.
Yeah, Jay is nodding away. If you have something to add here.
3.9 is the latest I've seen.
That's
We'll
extraordinary. That's
sell.
really extraordinary, the three handle,
It's
no?
crazy. It's
Mhm.
great. We've got like a little one-off townhome deal, that's probably going to trade around a 4.5 or a 4.6, just because it's small, and it's townhome. But I'm thinking about just holding on to it and seeing if I can get a 3.9 out of it, right? Yeah, I mean, it's I've never could have imagined that the cap rates would be this low. I wish I hadn't sold my 537 home portfolio that we traded last year, but it's all about timing, and I'm happy.
I'm sure it was a good idea last year. I'm sure it was
What's
a good
that?
idea last year, though. You gotta, it was a good idea last year, probably.
It was, yeah.
And it probably solved a problem then. So you can't.
It did. I'm not really complaining, but
We got to worry about the markets we're in, right?
I'm just hoping for twos. Cap rates of the twos. That's next.
I think I'm out. I don't know. My goodness. What about you, Jessica? What are you underwriting to? Like, what kind of yield in your market? Like, what is considered the right number right now there?
Well, we're clear. I guess build to rent, true build to rent is completely different because we won't purchase anything
You're not going to go with
below a 6% cap rate. So, I mean, when we're buying,
thank goodness there's somebody left.
When we buy off of builders, we're buying the actual directly from the builders, we're seeing, close to 6%. When we buy from, individual for sale owners, whether we need to renovate or we don't, we're seeing 11, 12, 13, 14, 15% easily. So, it is difficult to then, that's why we're kind of, going back and forth, whether we buy from builders or not, but it's really whatever inventory is available, we're buying, but we are definitely seeing significantly lower cap rates, but not as low as you're talking. We won't buy below a 6%. So
yeah, I think in bulk, it probably has that. It's because it's in bulk. Maybe, Jessica, because the larger investors can't get their money out fast enough and they're buying in bulk, it's actually depressing the cap rates even faster. And so I think that's actually really important for the audience to realize that when you're hearing things like a 3.9, that's true 100%, but it's a portfolio. It's a yielding portfolio where somebody can't spend the time to aggregate. And if you're somebody who's aggregating, you should be able to do significally better than that. I think is what
That's
I agree.
That said, even in the renovation, the renovate to rent, as you call it, Beth, where there are no.
I'm just waiting. Okay, so how many minutes after this is over are we going to see an article with renovate to rent?
You're trending now. Actually, I just got a notice.
Yeah, my daughter just posted it to TikTok.
But I haven't seen like 10% cap rates in renovation to rent ever, right? I mean, even in the old days, we were buying in the sort of 6.5 to 7.5. The paper yields were 9 to 10, but you can never actually achieve them. So
But that's what you were telling the investment committee, though, right, Jay?
I had the pen. I could do whatever I wanted back then. But yeah, I mean, it's if you're able to get the 10 plus and make it scale, I would, I think you should focus on it. That's amazing, because if you aggregate that stuff, you can sell it today for a 4 to 4.5, even scattered size.
Once you have a pool, because you've done the work, right?
But you don't have to have a big pool. I mean, you can have 30 homes to get that kind of cap rate right now.
So Amanda, when you're looking at the business plans, I know you approve the business plans on the larger construction borrowers that you have. What are you seeing in terms of kind of relative yield that people are underwriting to? Are people getting a 10? Are people looking for a 6? Like when you're kind of looking across a portfolio of people doing this construction, what is their kind of pro forma achievement here?
Yeah, most of them, obviously 30 plus portfolios are going to be, 6 or under for sure. Definitely on the other, smaller portfolios. Yeah, they're looking more, where Jessica is at the, 10 to 15%. Those are their projections at least.
But you're checking along the way. I mean, they're getting pretty close, right? With the rents usually.
Yeah, absolutely. Absolutely. Or above and beyond, what their expectation was.
So at least we're establishing there is still some value add available in the market.
That's exactly what it means. Yeah, it's great.
Right? I mean, that's the key, is that I think that there's obviously a huge amount of value to having, buying the land right, building out these communities, doing it correctly, leasing, but there's also a huge amount of value to the person who's actually doing some of the heavy lift in aggregating, because it's not that easy. We're not going to all be able to find a large parcel of land, or we don't all live in markets where land is even available necessarily. And so sometimes you do have to cobble it together. Or you can get paid to cobble it together, I guess is part of what comes across, right?
Can I ask the moderator a question?
Sure, please do.
So Beth or Amanda, either one of you that are out there a lot, there's so much talk about build to rent. What percentage would you say of the people that are out there actually doing build to rent are building, aggregating, and flipping versus building and trying to, have a long-term hold portfolio?
So the true fully integrated, all the way from building to holding the long-term portfolio, is actually quite rare. Despite the fact that you have been doing that for a long time and are, deep in that market, it is not that common. I think not everyone has the skill set all the way along, and some people play to their strengths. I would say that there is a stronger interest in the building sector, in selling to people who are holding these homes now, or in potentially building out their own communities like Lennar is doing, and having somebody like Jay manage it for them because they actually are an expert in the field, right? And so I think at least some of the bigger players recognize, wow, we know how to build, but we may not really know how to build to rent. We know how to build to sell, but this seems like a really good idea to add to our portfolio, but they're going to pull other people in who have the expertise. But I actually think that the biggest segment of the market is somewhere in between. I mean, Doug was mentioning that he, after leasing things up, will sell it as pools. We have several borrowers. I have one borrower who has been with us since the very, very beginning, who aggregates these pools, leases it up, and sells to the very large institutional players in pools of 30 to 40, and has been doing that for years. Before there was this, dispute between, is it build for rent or build to rent, but which is really like, you're in the luxury part of the market when that's the big question. But he's been doing this for years, and I think we kind of alluded to it if anybody was listening at the very beginning, before we started. It was really driven by the fact that the large institutional players were getting dinged by the REIT analysts for having kind of underutilized assets on their balance sheet. And so they actually really prefer to buy the house already stabilized if you're buying if you're an institution. And so this whole industry came up that actually buys the house, leases it, stabilizes it, and puts it in these ready-made pools, so that when it hits the institutional investor, they get credit for the rent right away, that they have productive assets. And so I think that's what actually started that piece of the market. But it has, there is a lot of work that goes into each phase. You know that because you're doing each phase. It is a different skill set and a different group. And I would say that the middle is where we're seeing the most activity. But a little bit on the front end, but very rare to have it all the way through. And I think that's one of the misnomers, actually, is that everyone is doing the whole thing. And everyone doesn't have to do the whole thing, is kind of the good news.
Yep. Agree with that.
So I think we're at the end. I don't know, Tuan, are you going to stop me now, or can I keep going?
I mean, maybe you can answer one or take one last question. Maybe we do some polls.
Yeah, there was one more interesting question, I thought, which was whether there's any, well, there's several more interesting questions, but one of them was most interesting to me. Is there some new technology or different technology right now? And we'll just do it really fast through, that's helping your business. And by the way, no is also an appropriate answer if there isn't any. Doug, why don't we start with you?
Yeah, I mean, again, because we're building these communities, we're looking at standardizing them all. We're using smart home technologies, which are, again, a growing demand by our tenants, and they want the whole package. They want to move in, have internet, and have a smart home, and have access, and all of that. That's helping. On the construction side, we're always trying to evaluate new technologies because of costs, to see how we can innovate, reduce cost, increase efficiencies or build times. I wouldn't say there's anything terribly new under the sun out there. Some of them promise a lot more, or they're just not cost effective yet, but everyone's trying, and we need to find solutions, because Lumber's too high.
Amanda, any ideas? You're seeing a bunch of different people. Anybody have anything cool lately?
You know what? No, not really. Like Doug alluded to, there's really nothing new and sparkly and shiny that has hit the market that is really going to change your business. It's very old school. I hope something comes out because, like Doug, we are constantly looking for innovation and new things, and it's just maybe not a priority or something like that, but hopefully somebody somewhere comes up with something that makes it more efficient for our borrowers and us as a lender. Jessica, anything?
The only thing I can say is that we actually, are seeing the lack of technology is helping us stay connected to our tenants. We're pretty hands-on since we're a family organization. We use tenant portals and all that, jazz, but staying connected is what helps us long-term, maintain our tenants.
Wow, Beth, I think I might be the only one then.
What do you got, Margaret? Tell us.
Technology push for us has been huge over the last, 18 months. We've invested literally millions of dollars in technology, all centered around property operations, really. I agree with Doug and Amanda that in construction, there's nothing new and funny, but within property operations, I wouldn't say that there's some great new platform out there. I think, in our case, we're having to build it. But I think that deep analytics and those capabilities are really important, being able to drive all your analytics all the way down to the individual house level within your portfolio so that you can, get into the realm where you're saying which house plan is driving the highest NOI, which ones aren't driving the highest NOI. So I think that for us, engagement with our residents, really building out platforms that help us. One of our owners likes to say that Camillo Properties, if we had a Facebook page and we had a status, we would be in a relationship with like 20,000 people. And so how do we really build that relationship with our residents? That's something where we're really applying a lot of technology. Again, on the lease up activities, we're having to deploy a lot of technology around lease up so that we can get the pre-leasing and those kinds of activities strong. And then a big, part of property operations is the maintenance and really trying to find ways for our residents to self-service. So whether that's through, videos or, how to, that the technology is the single biggest push that we've had as an organization over the last 18 months.
But all geared towards the residents, not the construction.
All geared toward property operations, not towards, construction or lending. Although we are revamping some of that as well, but it's not a shiny new penny, like Amanda said.
Yeah, and I would reiterate exactly what Margaret said. All of our technology pushes have been towards our property management proprietary platform, our maintenance proprietary platform, and our resident experience, right? So how they engage with us or how we're leasing the home to them. As far as technology in the homes go, I just want to figure out how to work the technology in my personal home that I finished last year. I've been in it for 6 months. I can't figure any of it out. None of it works. And I say that because honestly, that's one of my fears. What I don't want to be is a technology service company. I don't want to increase, I don't want to increase, our call center volume because the internet's out. I want them to call Comcast or AT&T. So we have been actually intentionally slow on putting some of that technology in. And the other reason is really nobody is clamoring for it. So we focused our technology spend internally. And you know what, if somebody comes out with just an incredible product, we believe the cost of retrofitting our houses is less than the cost of being wrong and putting the wrong technology in the houses now.
Well, fantastic. I have to apologize. We've kind of gone over. I want to thank every one of the panelists for what was a really interesting conversation for me, at least. and hopefully for everyone. We didn't really get to the polls, but that's okay. We'll send it out with the videos and send it back around to see what the audience thought about the different topics that Tuan put together in the pollings in the polls. So nobody has to stick around. We'll send it out to you. But thank you, each and every one of you. I think getting these different perspectives has been great for me, and I'm sure great for everybody who joined.
Thank you, Beth.
Thank you, Beth.
Thank you.
CoreVest is the leading lender to residential real estate investors. For more information about our long-term rental loans or short-term bridge loans, visit corevestfinance.com.